Good day. Welcome to another session of Fog Accountancy Tutorials. Today we are going to continue our lesson on depreciation of non-current assets. And so that is what we are going to look at, depreciation of non-current assets. Alright, so we are looking at depreciation. Now, in part 1 of this lesson, we looked at the definition of depreciation, and we also looked at some theoretical aspects like the methods in calculating depreciation, the factors to consider when calculating depreciation. And then we also went into detail to learn how to calculate depreciation using the straight line method, the reducing balance method, and the sum of the years they get method. In this lesson, we are going to go into double entry for depreciation. We are going to look at how to open accounts for the assets, for the depreciation, and for if there is any asset disposal. We'll look at that. We may as well explain or learn how to do the extracts for the income statement as well as the statement of financial position. And so without wasting much time, I would want to go straight into how to do the double entry for depreciation. Okay, so remember that under depreciation of non-current assets, you are going to prepare the assets account. So some accounts that are obvious to prepare, the assets account. You prepare the assets account, and then you prepare the depreciation account. But because it's an estimate, it's called provision for depreciation account. So you prepare provision for depreciation on the assets account, and then if there was any disposal of assets, you prepare the assets disposal account. Now, these are the three basic accounts that we will need to prepare under the double entry for depreciation. But then, sometimes you may be required to do extracts of the income statement, which I will explain later, and then some extras for the statement of financial position. For now, these three accounts are my focus. We are going to learn how to prepare the assets account, the provision for depreciation account, and then the asset disposal account. Now, remember that for a typical question on depreciation, the question is not likely to just tell you to prepare asset account. There will be a name for the asset, and so if the name of the asset is furniture, then you are going to prepare furniture account. Then that means that the second account will be provision for depreciation on furniture account, and then you are going to prepare furniture disposal account. So that is what we are trying to explain. So I'm using the word asset because I'm making it general for every type or particular kind of asset. But then when we are given a question, we are supposed to mention the name of the assets in our account. And so that is what we are going to do. So I'll begin to explain them. Now, beginning with the assets account. Take note that the assets account is a cost account. What do I mean by it's a cost account? So if this is your assets account, the only thing that we are going to record in this account is the cost of the assets. The only thing we are going to record in the assets account is the cost components of the asset. So in other words, when we are buying or acquiring an asset, we debit the asset account to show that there is an increase in asset. If we are selling off any asset or disposing of any asset, we will credit the asset account with the cost that we bought the asset for. So if we are buying an asset in 2017, we bought an asset for 100 cedis or 1,000 cedis, and then in 2020 you are selling the asset. The asset may have depreciated, but we don't care. Once I've told you that this is for the cost, you are selling the asset, and so you dispose of the asset and you record the same cost of 1,000. Don't record the net book value, don't record the depreciated value, or don't record the amount for which you are selling the asset. All those things will be done in the disposal account. Now, what you need to do is that once you record the asset on the debit side, it is going to be there. It's not going to be depreciated in the asset account. And so when you are selling off the asset, you are removing the cost component from the assets account, and then you are taking it into the disposal account. So this is a transfer to disposal. When we get to the depreciation, we record only depreciation in the depreciation account. And over there too, when we are selling any asset, we'll go into the depreciation account and we will take off every accumulated depreciation that pertains to that particular asset that we are selling. And so what I'm just trying to explain is that when we are selling off an asset, we have to take off the cost from the asset account, and then we'll take off its accumulated depreciation from the depreciation account, and then both will now meet at the asset disposal account, where we are going to determine the profit or loss on the disposal. And so please take note that I said that the asset account is supposed to record only cost. When you buy the asset, you record the cost at the debit side. When you are selling an asset, you remove the cost from the credit side. You are not supposed to record how much you sold the asset in the asset account. That will be taken care of in the asset disposal account. I'm sure that when we take a question, that will be more easier and practical to understand. So I'm not going to talk much. I'm going to go straight to take a question, and then we are going to use the question as an illustration to understand how to do these double entries with the asset account. Okay, so let's take this question. The following data relates to the fleet of vehicles of Payasi Company Limited. So we have a vehicle registration numbers, we have the date of purchase, we have the cost, and then we have the date of disposal. So vehicle registration numbers are there, JR 424T, sorry, and then AR 636A. We have CR 717B. Okay, so we have JR 424T, which was purchased on the 1st of January 2015 at a cost of 20,000 Ghana cedis, and the date of disposal for that asset is 30,000. The date of disposal for that asset is 30th June 2017. We have AR 636A, also bought on 30th June, and then at a cost of 30,000, and then there was no disposal, meaning we have not sold that asset. So you could read it from that line. So we have headings for vehicle registration number, date of purchase, cost, and date of disposal, as you can see on your screen. Vehicle number CR717B was bought on 1st January 2017 at a cost of 40,000 Ghana cedis and was sold on 31st December 2018. And then we have the last vehicle, ER252D, which was bought on 30th September 2017 at a cost of 50,000, and then there is no date for disposal, meaning that the asset has not been sold as at now. And then we have the next information, which says that the company depreciates its vehicles at a rate of 20% per annum using the straight line method on a 1-month ownership basis. The company's financial year ends at 31st December each year. You are required to prepare A, the motor vehicles account, B, provision for depreciation account, and then the C, motor vehicles disposal account, and then there is a D for profit and loss account and statement of financial position extracts. Then we said note, motor vehicles with registration numbers JR424T and CR717B were sold for 12,500 Ghana cedis and 22,000 Ghana cedis respectively. Okay, so this is the question that we are going to analyze. Now remember, it's a very simple question. We have grouped the items for us in such a way that it's very easy to know each vehicle registration number, when the vehicle was bought, and if it has been sold, the date of disposal is given, and the cost is given. Our job is to prepare the motor vehicle account and the provision for depreciation account. The motor vehicle account, I've told you, is very easy to prepare. We'll just use the costs, and then we'll just prepare based on the date they were bought. If there was any disposal, we just transfer out the cost of the assets from the asset register or from the asset account on the date that it was disposed of. But when it comes to the depreciation aspect, we need to prepare a statement of depreciation. Or better still, we need to do the workings for depreciation. We are told that this asset is depreciated 20% using the straight line method for all the vehicles that we are talking about here. And so we need to calculate depreciation using the straight line method for each of them. Now remember that the assets earliest year here is 2015, and then the last year here is 2008. So we are going to work from 2015 to 2018, sorry. So that is 4 years on the space. And so that is what we are going to do. We are going to calculate the depreciation for each of the assets for each of the years. Now, this calculation is what becomes a little tedious for most students, because there are so many vehicles, they are coming in at different times and they are going out at different times, and we need to respect. The question is telling that it's on a 1 month ownership basis. Now, even if the question has not mentioned the 1 month ownership basis, we would have still used the 1 month ownership basis. What is the 1 month ownership basis? The 1 month ownership basis simply means that we are going to calculate the assets depreciation based on the number of months that it was used in the business. And so if you bought an asset in March, at the end of March, for example, it means that it was not in the business for the first 3 months. So from April to December, it was in the business and it was being used. And so our depreciation rate should be applied on the cost of the asset. But we should also consider 9 months over 12 months. That is the meaning of the 1 month ownership basis. Now, if it was supposed to be the other alternative, now there is another alternative where you can meet a question and you'll be instructed that we are not supposed to use the 1 month ownership basis, but full year's depreciation should be charged in the year of acquisition. So it means that when you buy the asset, regardless of the month that it was bought, you charge a full year's depreciation. Then we can also be told that no depreciation should be charged in the year of disposal. So that is another condition you could have gotten, which I'm hoping to get another question of that condition and then solve with you. But for now, we are going by the 1 month ownership basis. It means that we will only consider the number of months that the asset was used, and then we'll calculate depreciation for those number of months. And that is what we are going to do. And so I'm going to go straight to the question. I want to do the asset disposal account first, but then I'm also thinking that let us do the calculation for depreciation first. Then afterwards, we can come straight onto the requirements. And so I'm going to do a workings where I'm going to show you how to calculate the depreciation using a simple statement of depreciation. And then afterwards, we can come and prepare the asset account and the provision for depreciation account as well. Okay, so we are going to prepare the statement of depreciation as workings. And so there are 4 assets in the question. And so I'm going to 1, 2, 3, then 4. And then let me So the first asset is JR424T. The second vehicle's number is AR. Okay, so this is the outlay of the statement of depreciation, and I'm going to call this place years. And so I have put the asset numbers in each of the columns. So this is assets JR, AR, CR, and ER, and that is the total. And then I'm going to put the number of years here. So the first year is 2015. Now, what we are going to do is that we are going to calculate depreciation for each year. Now, remember that all these are motor vehicles. And that is why I can calculate depreciation for each of them and then add that up to get the total for each year. and then we'll pick the total to prepare our provision for depreciation account. Now, mind you, if it was a motor vehicle and some of the assets were furniture, we wouldn't have calculated them together. We would have done for motor vehicles separately and would have calculated another provision for depreciation for the furniture also separately. And so we cannot mix depreciation for two assets. We can't do that. I am combining them because they are all motor vehicles and we can prepare for that. And so that is what we are going to do. And so we are going to calculate depreciation for each of them. And then at the end of it, we add up all the depreciation charges and then we'll get a total depreciation for each year. Okay, so we are going to calculate the depreciation for each year. But we are going to do that asset by asset and then we'll add that up to get a total for the year. And so in 2015, let's begin with the first asset, JR4240. The date of purchase was 1st January 2015. So it means we are told that accounting year ends on 31st December each year. And so we are calculating per annum. Now, if the accounting year ends 31st December and we bought the assets 1st January, then of course it was there for all the year, 12 months. And so per the 1 month ownership basis, we are going to calculate for the whole year because it was bought on 1st January. So it was there for all the 12 months. And the cost is 20,000. The date of disposal is in 2017. And therefore, it means for the 2015, we don't even know, it was not disposed of. So we calculate full depreciation for 2015. And so it will be 20% of 20,000. Let me put the currency sign up here for each of them. So 20% of 20,000. And it's for the whole year. And that is going to give us 4,000 Ghana cedis. And so that is the depreciation charge that we are going to have for the first asset. 20% of 20,000, giving us 4,000. Then the next asset is AR636A. That asset was also bought in 2015. But it was bought on the 30th of June. Now, according to the 1 month ownership basis, we cannot calculate a full year's depreciation for this asset because if you bought an asset in June, ending of June, it means that you use the asset for July, August, September, October, November, and December, and that is 6 months that it was in use. Remember that depreciation comes about because we are using the assets. But if we were not using the asset in the first 6 months, it wasn't there. We cannot calculate depreciation for that. And so we are going to calculate depreciation for the second asset, but for only the 6 months that it was in the year 2015, it was in existence. And the cost is 30,000. And so for the second asset, it's going to be 20% times 30,000 times 6/12. The 6/12 is here to cater for the 6 months that it was used in the business. And so the answer is going to be 3,000 Ghana cedis because it should have been 6,000 for 20%, but then this is a fraction that is dividing the number of months that it was used. And so we have 3,000 for the depreciation in 2015 for AR. I believe it's well understood. Then we move to the next asset. The next asset is CR717B. The motor vehicle was bought on 1st January 2017. Remember, we are working depreciation for 2015. This asset was bought in 2017. How can you depreciate an asset in 2015 that did not exist? So it means that in 2015, we are not going to get any depreciation charge for this asset because it was not in existence. And then the next asset, ER, was also bought in 2017. And so it didn't exist as at 2015. And so for 2015, we have only these two assets that were depreciated. The first one is 4,000 Ghana cedis. The second one is 3,000. So we are going to combine these two and we will have a total of 7,000 Ghana cedis as our depreciation charge for 2015. That is how you get depreciation charge. Ladies and gentlemen, I know that some of you are not so familiar with the statement of depreciation that I'm using. Some of you will prefer to do your own calculation of depreciation elsewhere. But remember that even if you do it elsewhere or in a misarranged form, you are supposed to still add up these two and then get the total depreciation for 2015. Sorry. If not, you will be heading towards a danger zone. So that is how we get our depreciation charge for 2015. 2015, and so we are done with 2015, and so the next year is 2016. So we move on to 2016, and so we are going to calculate depreciation charge year after year until we are able to get all the depreciation charges for each year. Then we'll move on to use these figures to prepare our provision for depreciation account. All right, so in 2016, the first asset was there because we bought it last year. But remember that it was disposed of, but the date of disposal. So as you are calculating, you should be considerate of the date of disposal as well. It was disposed of in 2017, and so for 2016, it was there for a whole year. So we are going to calculate depreciation for a whole year for that asset. And so in 2016, it will be 20% of 20,000 still, because it was there for the whole year. And that's going to give us 4,000 Ghana cedis. And then the second asset, which was bought in the previous year, was never sold. In fact, there is no date of disposal for that asset. And so we are going to calculate depreciation for a full year for the second asset this time around. We are not going to use any more fraction, because in 2016, it was there throughout the year. And the cost is 30,000. This is a straight line method. So we are going to calculate all on the cost. And so it's going to be 20% of 30,000. This time we are not going to multiply any fraction. So that is going to give us 6,000 Ghana cedis. Now take note that the method we are using is the straight line method. That is why I am using the cost in both years. Now if it was the reducing balance method, we would have subtracted last year's depreciation of 4,000 from the 20,000 to get a net book value of 16,000, and that means that in 2016 this 20% would have been applied on 16,000, which is when you take out the accumulated depreciation. And because it is a straight line method, we are going to use the cost throughout. So if you get a question that is not on the straight line method but is on the reducing balance method, don't forget to always use the net book values or the carrying amount of the asset and not the cost. So that is very important. Now we come to the third asset, CR. CR was bought in 2017. It means that in 2016, it was still not in existence. And so there is nothing for that. The same applies to the ER, was also bought in 2017. And so the total depreciation charge for 2016 will be 10,000 Ghana cedis, which is the 4,000 plus the 6,000. So these figures that we are getting as totals is what we are going to use to prepare the accounts. But how to get them is what I'm trying to teach you now. Okay. And so we are done for 2016's depreciation as well. And then we move to the next year, which is 2017. In 2017, this asset JR424T was sold. But it was sold, date of disposal is 30th June 2017. 30th June 2017. It means that the asset was in existence in that year, but it was used for only 6 months. After 6 months, it was sold. So we will still calculate depreciation for the asset according to the 1 month ownership basis. We will still calculate depreciation for the asset for the period that it was used. And so it was used for 6 months in the business. And so it will be 20% times the cost, because it's a straight line method, times 6/12. And that is going to give us a total depreciation charge of 2,000 Ghana cedis. And now we have sold the asset. And so next year, we are not going to calculate depreciation for that asset. I believe you are getting it. Yeah. And then we move to the next asset, which is AR636A. Now, that asset was never sold, so it will be there throughout. And so we will calculate 20% of 30,000. And then we are going to get our 6,000 again for that asset. Then we move to the next asset, which is the CR. We are in 2017. That asset was bought in 2017, and so now it becomes relevant for our calculations. 1st January 2017, it was bought, and it was sold, but it was sold in 2018. And because it was bought on the 1st of January, we are preparing accounts to 31st December. It was there for the whole year, so we don't need to add fractions of the month in our calculations. And so that is going to be 20% times 40,000. The cost of the asset is 40,000, and that is going to give us 8,000 Ghana cedis. So that is what we are going to get for the CR, 8,000. And then we move to ER 252D, which was also bought in the same year 2017. Now, in that 2017, it was bought on the 30th of September. That is what the question is telling us. It was bought on the 30th of September. And because it was bought on the 30th of September, we used it that year for October, November, and December alone. And so it's going to be a 3-month ownership basis. And so the cost is 50,000. So we apply 20% of the cost, 50,000, times 3/12. And so that is going to give us 2,500 Ghana cedis as our depreciation charge for the year. 2,500 Ghana cedis will be our depreciation. That is when we apply the fraction, and then we are going to get a total depreciation of 2,000 plus 6,000 plus 8,000 plus 2,500, and that is going to give us 18,500. Okay, so 18,500 Ghana cedi becomes our total depreciation charge for 2017. Interesting, right? But I'm sure you are understanding me well. And then finally, we move to the last year, which is 2018. Now, in 2018, this asset was sold in 2017, so it will not be relevant for our calculations in 2018. It is no more there in the business. And then the AR was never sold, and so it will still be there in 2018 for our calculations. So that will be 20% times our 30,000, because it's still the straight line method. We use the cost throughout, and that is going to give us 6,000 Ghana cedis. And then the CR was sold in 2018. Let us look at the date that it was disposed of. The date of disposal is 31st December 2018. 31st December. It means that even though we are selling it, it was used throughout the whole year till the end of the year. So there will be no fractions in the months. And so still we are going to get a full year's depreciation for this asset, 40,000, without any fractions of month. And that's going to give us 8,000. But still, it has been sold in 2018. And then we come to the last asset, ER, which was also never sold according to the question. And this time it was used throughout the year. And so it will be 20% times 50,000. And that's going to give us a depreciation charge of 10,000. And so we close the year and we have a total depreciation charge of 24,000, which is 6 plus 8,000 plus 10,000. So we have 24,000 Ghana cedis. And now, after we are done with this, we'll create another column for total. And then we are going to have the total accumulated depreciations of each of the assets. And I'll tell you the importance of that. So for this asset, it's going to be 10,000, which is 4, 4, and 2,000. And then for this asset, 3,000 plus 666. So we are going to have, is it 20,000? Yes. 20,000. No, 21,000, sorry. 21,000. And then we are going to have 16,000 for that. And then we are going to have 12,500. We can, of course, add up this and put the total here, or add up that and put the total here. But that is not too relevant to our calculations. But of course, I can still put it there. 9,500. So that is our total for whatever that we are doing. Now remember that I told you that when we are preparing the provision for depreciation account and we sell an asset, we are supposed to remove the accumulated depreciation of that asset from our accumulated depreciation. And so when we are selling this asset, the accumulated depreciation of the asset at the date we were selling it was 10,000. And so that is what we are going to remove out. When we are selling this asset, we are going to take out 16,000 as its accumulated depreciation. That is the meaning of what we are doing. Okay, so basically this is the provision for depreciation. I'm going to clear this off, and then I'm going to prepare the assets account and then the provision for depreciation account. So let us take note that we had 7,000 for 2015, 10,000 for 2016, 18,500 for 2017, and then 24,000 for 2018. These figures are what I'm going to use in the preparation of the account. So when I clean this and I start using these figures to prepare the account, don't get confused. I'm going to use it for the provision for depreciation account. For the asset account, I'm going to go straight away with the cost. Okay, so I'm going to clean the board and I'm going to prepare the asset account first before the provision for depreciation account. Okay, so I'm going to prepare the motor vehicles account, which is the first requirement. So we are supposed to prepare the motor vehicles account. I'm going to show my currency sign up here. And then remember that we are going to prepare it year after year. We are not going to mix up the years. So I'm going to show the years. So the first year is 2015. 2015. And I told you this is a very simple account to prepare. All you need is the cost of the assets. That is all you need, the cost of the assets. And so we begin. In 2015, I told you this is only for the cost. So in 2015, we bought two assets, the JR and the AR, all in 2015. Now, on 1st of January, we bought the assets by, let's say, cash or bank. Let me assume it's cash. And that is the JR 424T. And then we bought that asset for 20,000. So that is the cost of buying the asset. We write the cost there. In the same 2015, we bought another asset on 30th June. And the asset is AR 363 or 636. And that is 30,000 on the 30th of June. Okay, so that is all for 2015. In 2015, we didn't sell any asset. I told you that when you are buying, you debit. When you are selling, you credit. But it should all be the cost. And so because there was no disposal, we are done with 2015. So we can close off this account in peace. And then balancing off an account, we know how to do it from our double entries. So the total will be 50,000. And on the last day of the year, 31st December, there will be a balance carried down of 50,000 on the motor vehicle account. And then we move to the next year, 2016. Now, in 2016, on 1st January, there will be a balance brought down of 50,000 before we even begin the activities for 2016. And so in 2016, there was no acquisition. Looking at the date of purchase, we didn't buy any assets and we didn't sell any assets as well. And so we'll straight away close the account again at the end of the year. Balance carry down 50,000. We close it off and then we move to the next year, 2017. Okay, so in 2017, we'll come back to 1st January and then we'll bring the balance down. Balance brought down, still 50,000. But in 2017, we bought some assets and we sold some assets. And so in 2017, on 1st January, we bought the asset CR. So 1st January, there was a purchase of cash, which is for the asset CR717. So CR717B. And we bought that asset for 40,000. We bought another asset on 30th September. So 30th September, there was another purchase for the asset of ER252. So ER252 and at a cost of 50,000. So remember that you do your acquisition, then you do your disposals on the credit side. It's very, very simple. So because there were disposals, there was only one disposal, and that is for the asset JR that we bought in 2015. So we are selling that on 30th June. So on the credit side is for disposals. So 30th June, we will name it disposal of the JR 424T assets. And it was bought at a cost of 20,000. So when you are selling it, you will record the same 20,000. Don't tell me, but it has depreciated. Oh, no. I told you over here, we are not interested in whether it has depreciated or not over the years. All we are interested in is that we are selling it. So we are removing the cost from our assets account. When we get to the accumulated depreciation account, we remove its accumulated depreciation also. That is what we need. And both of them will meet at the motor vehicle disposal account, where we are going to now determine whether we are making profit or loss on the sale. So for now, when you are selling an asset in the asset account, all we do is the cost. We are told that this asset was sold for 12,500, but that is not what we need to record. You just transfer out the cost. I will show you where you are going to record that as well. And so that is the only asset we sold. And so at the end of the year, we will do our balance carry down as usual. We close the account and we'll do a balance carry down. The total is 140,000. And so the balance carry down will be 120,000. And then we move to 2018, which is the final year. Now in that year, on the 1st of January, there will be a balance brought down of 120,000. Before we look at the activities for that year. In that year, there was no acquisition. We didn't buy any new asset, but we sold an asset. We sold the CR717B. And so it will come to the credit side. On the 31st of December, there was a disposal. We call it disposal, take note. And that is for the CR. And we bought the CR for 40,000. That means when you are selling it, it is the same 40,000 you record in the asset account. Don't worry about depreciation. We will get there. So that is what we do. And then we are done. Nothing more to add. Because the only things that matters with the motor vehicle account or the asset account is acquisition and disposal. And remember that whether it's acquisition or disposal, we record only the cost. Okay, so then afterwards we will look at our balance carry down on the asset account, and that is going to be 80,000 because we have a total of 120,000 for both sides. So we are done with our motor vehicles account. I believe you are okay with the motor vehicles account because we are moving on quickly to prepare the provision for depreciation account. So provision for depreciation on motor vehicles account. So bring your currency sign as usual, and then we are going to prepare year after year. So we begin with the first year, 2015. That is what we are going to do, provision for depreciation on motor vehicles account. Now with this provision for depreciation on motor vehicles account, now this account has a debit balance, the asset account. The provision for depreciation account has a credit balance. So just like we record first on the debit when we are buying, over here when we charge depreciation, we record on the credit first. But the double entry for depreciation is such that we credit the provision for depreciation account and then we'll go and debit our profits and loss account. And so just like we wrote cash here for debit, meaning that we are going to credit cash account for buying an asset. The same way we are going to record at the credit side, but we are going to call it profit and loss to tell us that we are going to debit our profit and loss account for expense. And so we are going to now use the workings that we did, the statement of depreciation that we prepared. For each year we had a total, and the totals are what we are going to use to prepare this account. And so in the first year, it will always be on the last day of the year. For depreciation, it will always be on the last day of the year, except there is a disposal that the date will change. So 31st December, we'll call it profit and loss. And the total amount we had was 7,000, if you could remember. You can remember from our statement of depreciation, we had 7,000. So we will write that for that year. And then remember that I told you that we charge depreciation here, and if it is disposal, it goes to the opposite side. But in 2015, there was no disposal. So that is it. We are done. So we close the account. At the end of the year, 31st December, there will be a balance carried down of 7,000. So we are done with the first year, as easy as A, B, C, D. All right. So in 2016, We continue. Now the balance carried down appeared on the credit and debit side, and so on 1st January of the next year, balance brought down for accumulated depreciation will come at 7,000. And then we move to the statement of depreciation that we prepared. In the second year, it was 10,000 that we had, and so it will be on the end of the year as we did, and we'll call it profit and loss. And then we'll add that as 10,000. We will just be accumulating. We'll be adding up the depreciation. In 2016, there was no disposal. If there was disposal, after recording profit and loss, we would have come to record the disposal of the depreciation as well. And so we didn't sell any assets. And so that is all for 2016. We will close out. You close off the account, and then the total will be 17,000. And that will mean that at the end of the year, our balance carried down will be 17,000. And then we'll move to the next year, which is 2017, to continue. And in 2017, we bring the balance to the credit side as brought down. So balance brought down 17,000. We are still accumulating. That is why we call it accumulated depreciation. We add up, we accumulate. So in 2017, the depreciation charge that we had from our statement of depreciation, which is going to profit and loss, is 18,500. So we accumulate, we add up. But remember that in 2017 there was a disposal. In 2017 we sold the asset JR 4240. So we need to remove the depreciation of that asset. We are selling it. So if we are selling off the asset, why should we maintain its accumulated depreciation? So we have to remove. And remember that we sold it on the 30th of June. So we call it disposal. So you will see that over here, when we are selling, I called it disposal. Over here too, we call it disposal. The same thing. So that the corresponding entries will meet in the disposal account. The accumulated depreciation for the JR that we are selling is 10,000 Ghana cedis. 10,000 Ghana cedis. How did I get the 10,000? Remember that I added up the total downwards for the assets and we had 10,000. If you think you are confused and you don't know how to get the accumulated depreciation is a measure of how much depreciation the asset has incurred from the time it was bought to the time it's being sold. It was bought on the asset was bought on the 1st of January 2015 and is being sold at 30th June 2017. This is exactly 2 years, 6 months. So that is 2.5 years. And so if you want to find your accumulated depreciation without even going back to your table, you can just say the asset was bought for 20,000. So the rate is 20% times 20,000 times 2.5 years. And this will still give you 10,000. It tells you that for that 2.5 years that we have used the asset, its depreciation is 10,000. So that is how you know the accumulated. But the statement that I prepared for you will still give you the 10,000 if you sum up downwards. Okay, so we remove the depreciation of the assets we are selling, and then we are done for 2017. And so we'll close off the accounts as well. And the total will be 35,500. So in 2018, we'll bring the balance down on 1st January as our balance brought down 25,500. And I told you we are accumulating. You see that when we reduce, accumulated depreciation has gone down. Then we add up the depreciation charge, which will always be on the last day of the year, profit and loss, for 2018. So in 2018, our depreciation total was 24,000. 24,000. And so what we are going to do is that we'll ask ourselves, was there any disposal? Yes, there was a disposal. We sold the asset CR, but it was on 31st December. So we'll put our disposal first. And then when we write the disposal, we look for the accumulated depreciation. And from what we did, the accumulated depreciation of that asset is 16,000. So that is 16,000. And so 31st December, we have a balance carried down. We close off the account and we have 49,500. 49,500. And so the balance carried down will be 33,500. And so this is how we end our provision for depreciation account. I'm sure it's very simple for you now, preparing your motor vehicles or asset account and preparing your provision for depreciation on the motor vehicle account. Now we are left with one very important before we talk about the extracts. We are left with the disposal account, which I'm going to clean off this because of space, and then after cleaning that off, we'll prepare the disposal account. But take note that the disposals happened in 2017 and in 2018. In the first 2 years, there was no disposal. It means that when we are preparing the disposal account, we'll do for only these 2 years, only 2017 and 2018. And also take note that every debit entry should have a corresponding credit entry. And so the crediting of disposal accounts in the motor vehicle means that we are going to debit the disposal account with the 20,000, and then we are going to also credit the motor vehicle disposal account with 10,000. That is how the double entry is going to be like. All right, so I'm going to clean this off, and then we are going to prepare the asset disposal account. Okay, so we prepare the motor vehicle disposal account. Bring our currency sign, and then I told you we are doing for only 2017 and then 2018. Now, in 2017, we realized that on 30th June we disposed of an asset. So in the asset account, it was on the credit side. So we'll come to the debit side here to complete the double entry by recording the date, which is, and it will be in the name of motor vehicles, 20,000. That is, we have removed the cost and we have brought it here. Then on the same date, remove the depreciation. So it will be in the name of depreciation, and that is 10,000, or provision for depreciation. So what we have done is that we are matching the cost against how much has been written off. So we bought the asset for 10,000. We've used off. We bought the assets for 20,000. We have used off 10,000. This is when we are selling the asset. Now, take note that we were told that motor vehicles with registration number 4240 and CR 717B were sold for 12,500 and 22,500 respectively. Now, the purpose of the disposal account, it works like a profit and loss account, is to find the profit or loss on disposal. So, obviously, let's do this analysis. If you bought an asset for 20,000 and you've used off 10,000, how much will you be left with? You'll be left with 10,000 of the value. So if you are selling it for 12,500, you are making a profit of 2,500. So this is what this account basically hopes to do. And when you are selling and you are receiving that cash of 12,500, you debit your cash account, and so you would credit motor vehicle disposal account. And so on that date, we are going to say cash of 12,500. So now that we have recorded cash of 12,500, we are balancing off this account. We have 22,500 as total. 22,500 as total. We are going to get a difference of 2,500. This difference cannot be called balance carried down. It's either a profit or loss, and in this case, it's profit. So we'll say profit on disposal, or you can simply say profit and loss. But in your mind, because it's going onto the credit side of the profit and loss account in effect, because it's other income, profit on sale of the asset. And so this is how it's going to be. We have a profit of 2,500. So the purpose or the essence of preparing the disposal account is to find the profit or loss on disposal. Now let us look at the asset that was sold in 2018. The asset that was sold in 2018. And that asset was bought for 40,000. So in 2018, the cost that we transferred out on the day that we are selling, so in the name of motor vehicles, the corresponding entry will be 40,000. That is what we did. And then remember that the depreciation component that we transferred out, depreciation was also 16,000. Now let us look at something. We are told that this asset was sold for 22,000. Now, if the asset was sold for 22,000, meaning that we are taking cash of 22,000 for the asset, determine whether it's a profit or loss. You would see that if you take 16,000 out of 40,000, you should have gotten 24,000. That is the value of the asset that is left. So if you are selling it for 22,000, you are selling it less than the actual value of the asset now. So you are making a loss. So if you are balancing off this account, the total will still remain at 40,000, but then you are getting a difference of 2,000, which you call profit and loss, or you can simply call loss on disposal. But I'm calling them profit and loss to make your extract easier, because when you are doing the profit and loss account extract, which they require, you are supposed to look through your provision for depreciation account and the asset disposal account. Everywhere there is profit and loss, you take the corresponding entry. That is all it's about. So the extract is just about do the corresponding entries of this. So in the profit and loss account, this profit and loss will appear on the credit side as an extract, and this will appear on the debit side as an expense. This is going as other income. That is why it will go as a credit. So if you don't call it profit and loss and you just name it as loss, you may forget to come and pick it. That is why I like to narrate that as profit and loss, so that I will see it when I'm doing my extract, and then I'll pick it along. So this is how the motor vehicles disposal account will look like. Okay, so I think we are good to go. Now let us try looking at the profit and loss account extract. Okay, it's just an extract, so we are not going to do any serious balancing. Let me go by the T profit and loss account. So profit and loss account extract. Okay, so this is what we are going to do for the extract. We are going to go year by year. Remember that the profit and loss account, the debit side is for the expenses and the credit side is for other income. And so what we are going to do basically is to go through the provision for depreciation account and the disposal account. Wherever we see profit and loss, we transfer. And so in the provision for depreciation account, if you could remember, on the credit side is where we recorded all the profit and loss, which was supposed to be for the depreciation. And so in the extract, we'll call it depreciation. So that year, depreciation for 2015 was 7,000. You just show how it will reflect. And there was nothing more. Then you move to 2016. You are not going to close it. You are just showing it. So in 2016, depreciation was 10,000. There was no disposal, so there was no profit or loss on disposal. And then in 2017, the depreciation charge for the year was 18,500. But in the disposal account, we have profit and loss here, so it will appear on the credit now. So we are going to have profit on disposal of assets, and that one is 2,500. So this is how it will be. You are just showing the corresponding entries at every place that you narrated as profit and loss. And then in 2018, the depreciation charge was 24,000, but there was a loss here, and so because it's still at the credit, you show it as a loss on disposal, which will end up as an expense 2,000. You are not going to add anything. You're not going to do any totals. All you need to do is just to show this. That is why it's an extract. You are showing how these things will appear in the profit and loss account. So we are done with the profit and loss account extract. If you are able to do a very proper work with your profit and loss, with your provision for depreciation account and then the vehicle disposal account, I don't see why the extract of profit and loss account should be a problem for you, because you will only be needing to, you only need to be transferring your profit and loss figures into their places where they belong. So we are done with the profit and loss account extract. As for the statement of financial position or balance sheet extract, it's very easy. Those ones will just go by the way we do it in our statement of financial position. We have the cost, accumulated depreciation, and then the net book value. So you are going to show how it's going to be. And in that place, we are going to use only our balance carry downs. Remember, I'm telling you only the balance carry downs. That is what we are going to do. So we take all our balance carry downs and then we use that for the statement of financial position extract. And so let me just do that quickly down here. Statement of financial position extract. So we'll have our net book value, our accumulated depreciation, and then the cost. So just like we do for statements of financial position, you mention the asset, and by this time I'm going to do it year after year. And so in 2015, okay, watch, in 2015, the motor vehicles. Now, under the cost, you would go and pick the balance carry down of 2015 in the motor vehicles account, because I told you in that account is for cost alone. Then under the accumulated depreciation, you will go and pick the balance carry down of the provision for depreciation account for 2015, and then this minus that will give you that. You pick your calculator and subtract the accumulated depreciation from the cost to get your net book value. So that is what we are going to do. And so in the motor vehicles account for 2015, the cost, the balance carried down was 50,000. And in the accumulated depreciation, we are not picking the profit and loss, we are picking only the balance carried downs. The balance carried down was 7,000 in the provision for depreciation account. And so this minus that will give us 43,000. This is all the examiner is requiring you to show. Then you move to the next year, 2016. You are not going to do any totals. You are just showing how it will appear. So in 2016, motor vehicles, the balance carried down for 2016 was still 50,000. The balance carried down was still 50,000. But the balance carried down for accumulated depreciation was 17,000. If you could remember, because now we have added the 10,000. And so our net book value for 2016 will stand at 33,000. That is the meaning. So this is how the statement of financial position extract will look like. We'll do the same for 2017. 2017 motor vehicles. Now, the balance carried down for the motor vehicle account in 2017 was 120,000. Was 120,000. And the accumulated depreciation for the provision for depreciation account in 2017, the balance carried down in 2017 was 25,500. Yes, was 25,500. And so the net book value will be 94,500. That is what you are going to get when you subtract this from that. And then finally in 2018, for motor vehicles, the balance carried down for the assets account in 2018 was 80,000. Was 80,000. And then the balance carried down for the provision for depreciation account in 2018 was 33,000. Sorry, it was 33,500. And so if you subtract 33,500 from 80,000, you are going to get 46,500. And that is going to be your net book value for 2018. And so this is what we mean by the statement of financial position extract and the profit and loss account extract. All right. I'm sure you have really been helped by these explanations. And I know that from henceforth you are going to practice some more questions and get it. Now, we are going to do another question another time with the reducing balance method, but you should try it on your own first and then try and see if you will be able to do. That will only change the way we calculate depreciation. But the double entries and whatever I've done here in the account will be the same. And then also look at a situation where there is no 1 month ownership basis, but maybe we are instructed to calculate the full year's depreciation in the year of acquisition, but no depreciation in the year of disposal. So that is also another possibility where we have to look at. But until then, I just want you to enjoy yourself solving more examples. Remember to subscribe to this channel, share this video for others to have a benefit, comment and let us know your feedback, and I'm sure that together we'll achieve the success. God bless you, and until we meet again next time, it's bye for now.